Well, thank you all for joining us at our 9th annual Startup Boston Week. I can't believe it's our last day. The mission with this conference is simple: to bring together the entire startup community across every industry, department, and funding stage. Startup Boston exists to connect, educate, and celebrate this ecosystem while serving as a trusted, unbiased guide to the best resources that can help you start and scale your startup or your team. My name is Elena Lobianco. I am a consultant with TriNet, where we provide a scalable HR infrastructure for startups and small businesses to be able to scale confidently, compliantly. I will be your host today. Before we dive in, I do want to give a huge shout out and thank you to Suffolk University for hosting us. Suffolk has generously partnered with us for the past 3 years, providing this space in kind because of their deep commitment to supporting Boston's startup community. If you're interested in exploring entrepreneurship, they do offer a variety of programs and opportunities. So be sure to stop by their table. They're right outside in the vendor hall to learn how they can support your journey, or how you can maybe get involved supporting their entrepreneurial students as well. We have a fantastic panel for you: building a VC fund from the ground up. I will kick it over to our wonderful moderator, Rumika. She does things on the side, but she's one of Startup Boston's own. So very excited for this panel and excited to get into it. Thank you.
Right. Thank you, Elena. I'm Rumika, your moderator for this panel. Welcome, everybody. With the 3 seasoned investors here, we are here to explore the realities of starting and scaling a VC fund in its competitive environment. I'm an analyst at BankTech Ventures. We are a strategic VC fund backed by 100 plus community banks, and we invest in the future of banking. Like many sitting in the audience, some point in the future, I want to start my own VC fund, and I have a lot of questions for you today. Why don't we start with introductions? Will, do you want to go first?
Yeah, sure thing. Will Lehman, founder and GP at Step Function. I invest early in technical founders building infrastructure software companies.
Okay. Really?
Sure. Hi, everyone. I'm Lily Lyman. I'm a partner at Underscore VC. We're an early stage firm based here in Boston. We invest at pre-seed and seed in the world of B2B software.
Hey, I'm Alex Bennick. I'm a founder and partner, only employee, solo GP fund of Encoded Ventures. I also invest in deep infrastructure technology, cloud, data and AI infra, and some security. And yeah, before that, I spent a lifetime at Battery Ventures, both in the Bay Area and here in Boston.
Great. Lily, I'll start with you.
Sure.
We mostly see that people who have worked in finance or who are exited founders, they end up becoming VCs. But you come from a corporate background. You were in Facebook before, not from a technical background. How did you decide that you want to start your own VC fund?
Sure, it's a good question. So quick background, I was at Facebook for about 5 years before I joined Underscore. I was on the international growth team trying to get the next billion people connected to the internet so that they could join Facebook's platform of products. Prior to that, I'd gotten my MBA out of Stanford, and before that, I'd done a variety of operating and founding roles. Along the way, I had founded a company while I was at Stanford, and then I had also started angel investing. So I think that was the piece for me, both while I was in business school and while I started angel investing during my time at Facebook. I actually got involved with Yard Ventures, which I think the alumni venture group was here before this. I was on their first investment committee, and that's when I started working with entrepreneurs and looking at decks and making investment decisions. And I was like, oh, I like this. Maybe I should be doing this. I was looking to move back to the East Coast, originally from the East Coast, and got lucky enough to get introduced to the Underscore team quite early. So actually I wasn't part of the founding team. I was the first hire after the founding team got going. So they had raised their first fund in 2016, and I joined sort of shortly after that at the end of 2017. So I've been a part of our second fund, which we raised in 2018, and then we closed our third fund we launched it in 2024. So I guess it's funny, people say, like, what's the right path into venture? I actually don't think there's one path. One of the best VCs I know was a journalist before this, Rebecca Caden at USV. I mean, we all have sort of slightly different backgrounds. So I don't think there's any one path. I think it takes a certain set of skills, but I also think there's different ways to be good at this job. And so mine happened to be sort of a combination of founder, operator, and angel investor that led me here. So that's how I ended up here.
Interesting. Alex and Will, you both raised your first fund in the last 2 years. You come from established VC firms, Battery Ventures and Bain Capital Ventures. How has the transition been for you coming from a large VC established firm to starting your fund from scratch?
You want to go? Want me to go?
You go for it.
Yeah, thanks. There are many differences. I started Battery on the West Coast in 2001, Battery 6, they're currently on Battery 14. It's a $3.5 billion fund. I have an $18 million fund. There are many obvious differences. The two that I think about most are one around just decision making. Like, of course, I'm a solo GP. I have incredible freedom to back the kind of founders that I want to work with. And of course, much less internal process and things like that. But you also lose the, kind of benefit of everybody's internal network and their relationships and the fact that there are a lot of smart people walking those halls. And so you have to make up for that in other ways with your investors, with other co-investors. And so I think about that quite a bit as one of the major differences. And then, of course, pace. I don't think anyone who knows Battery would say it's a high volume organization. They do a relatively smaller number of relatively larger deals. So you generally are like, is this the best deal I'm going to see all year mentality? And, with my fund size and check size and stage, I'm thinking about doing plus or minus, low 20s number of deals in 2 or 3 years. So I have to do 7, 8, whatever it is, deals a year. And so for the most part, that's liberating because you can take more shots. But you still have a line and you have to think about where that line is in a, somewhat of a rigorous way to still figure out sort of what's above and below it. Of course, you can make exceptions from time to time, but sort of decision making and pace are two of the biggest differences that are top of mind for me.
Yeah, one, agreed with all of that. So I was at Bain Capital Ventures for about a decade, and I think similar to Alex, big firm, both Bs, both blue collar schemes. But beyond that, very much high conviction, lower volume type of environment. I'd say the two biggest things I'd focus on in terms of differences. One is brand. You're at one of these funds where they've been in existence for several decades before you get there. They've been part of these huge IPOs, M&As, whatever it is. They're on all the lists, and so there's a lot of unaided recall already amongst the founder community of, hey, Bain or Battery should be on the short list. And with Step Function with Encoded, it's slightly different. At a slightly earlier stage in our journey, so still earning the right to be on those lists. And I will say that as I'm doing this more, and I see more founders who are part of the broader Step Function family, those founders are a lot more incentivized to go to bat for you because of that tie between the personal brand and the fund brand. In a way which maybe they don't feel quite the same way for the big multi-stage firm, which is working with hundreds of founders. The other big difference is the actual operational components of running a fund. So every time Bain raised a fund, they had a highly professional IR team that would go and get the right limited partners together and get them excited. And occasionally you'd get trotted out to talk about your investment thesis or your most recent investment and get them excited about that. But they handled all the heavy lifting and the actual process of building a fund. So when you're doing it yourself, you actually have to think from first principles of, well, why does the world need another venture fund, and actually have to convince people to not just believe in that narrative, but also believe in you. And that was a new learning for me starting Step Function.
And an incredibly humbling one, which creates much more empathy with the founders that are pitching us. So.
Yeah. Following up on that, Lily, you raised your first fund in 2018. It's been 8 years, and you've raised about 3 funds now. Does it ever get easier raising from the LPs? And what are some of the metrics that LPs and everybody looks at in a fund?
Yes, so for context, so we have about 300 million assets under management across 3 funds in Underscore's history. I think the conventional wisdom is sort of fund 1 is very hard to raise because you're new and you're unproven, although many times you come with a track record from a previous fund. I mean, you both had that. My partner, Michael, who founded the firm, had that as well. And so we actually were very fortunate where he brought a lot of very institutional blue chip LPs with him to Underscore's Fund 1, which is pretty rare to have children's hospitals and universities and folks like that as part of a first fund. So we are very, very fortunate, and I give full credit to Michael and his track record in that. It's interesting. I think same with founders, you can either raise on promise or you can raise on proof. And I think in a Fund 1, you're raising on mostly promise. I think in most cases, LPs are underwriting you for at least a Fund 1 and a Fund 2 because, as many of you know, this takes a very, very long time to realize results and metrics. In the pre-seed seed world, it can really take 10 to 12 years. It used to be sort of 7 to 10. It's longer now. And so many funds tend to raise on a sort of a 3-year fund cycle, or that's how we do it. We think about it every 3 years. We want to be bringing a new fund online. And so Fund 1 and Fund 2 are really about sort of promise. By Fund 3, you need to have some proof. But again, it can be early indicators of proof. And what I mean by that is, the two big things that LPs really care about, at the end of the day, they care about distribution. So I gave you $1, are you giving me $3 back? And that is what they're ultimately investing in for our asset class. Hopefully, if they give us $1, what they really want is $5 back, but very hard to do that. And so by Fund 3, and we're thinking about the next fund next year will be Fund 4, that's what they want. The leading indicators of that is what is the value of the dollar I've given you. Even if you haven't actually put it back in my hands yet from distributions, it's like how much have you grown the value of that? That's called TVPI. So that's what they tend to look at by the time you're at sort of a Fund 3, Fund 4. And so those are the metrics. What's hard for LPs is before you have those numbers, because it's so early, the first couple years, they need to look at sort of the leading indicators. So that might be, what have you invested in? Has it gotten a follow-on investment? And from who? And how is that business actually doing? Do they have real ARR? What is their customer traction? So, but if you think about them, they're working across a lot of different asset classes. So it's hard for them to get so detailed on this company has this much revenue and is doing this incredibly exciting thing. It's hard to get their attention on it. So this is sort of a long-winded answer, but those are some of the things that they look at. I think I've heard, you've been in places that have raised more, but I've heard Fund 1, Fund 3 is hard because it's kind of a teenage year, and then actually Fund 6 is quite hard, I've heard, because I think that's when you often maybe have a generational transition. You have new partners who maybe are coming online. We haven't hit that journey yet, but those are the 3 that I've heard are the hardest to raise. We actually went through a generational transition at our Fund 3. So the founders of the firm stepped back, they handed it over to myself and my partners as the next generation. So in some ways, that fund was almost like a Fund 1 for our team.
Alex and Will, you both recently raised. What is the fundraising environment like for the investors right now? And for anybody who wants to start their own fund, let's say I want to start my fund in 3 years, would you suggest that I start engaging with LPs now, start building those relationships, or what were your learnings?
Yeah, I think similar to one of Will's comments, Battery, I wasn't that deeply involved in fundraising, and also the LPs who are Battery's LPs are not really the right LPs for a small fund. For the most part, there are definitely exceptions there. My strategy was much like a founder strategy. I left on July 1st, took a few months off, and then I was thinking to myself, well, how can I get going as soon as possible? And with institutional LPs, no matter how long you've been doing venture, you're going to get thrown into a bucket that's called emerging manager, which means it's your first time raising a fund, which is true. And so I basically did friends and family first close. And my friends and family were some of the folks from Battery and Battery founders and people who had been at Battery and left. Many entrepreneurs I worked with at Battery over the years. And then sort of just a group of people you've grown up with in the industry over the course of your career, including in that bucket as many non-Battery founders who I knew and who wanted to invest for any amount of money they wanted to invest, because the best deals come from founders and you want them on your team. And people are busy. You can only think about so many things, but you have a little bit of skin in the game and you think about things more. After that, I did a second close which did have a couple of family offices, and which are basically, if you don't know, people who manage money for, in large individual families, or sometimes multiple families kind of run by one manager, and then one fund of funds. And so that process takes a while. Raising from institutional LPs, when you're first getting started, is a slow process. And so that's why I wanted to kind of get going as soon as possible. Like, it is a relationship business, and so one of those three, I had a prior existing relationship. I would say two are net new, who I just met or was introduced to and pitched. They didn't know me, I didn't know them. But in general, even now that I'm not fundraising, you sort of take any potential investor meeting for the sake of relationship building, getting to know each other, the same way, I would take an investment meeting with, a startup, so you can see how it evolves. So yeah, I can never hurt to get to know people who could potentially, be your investors down the road.
Will, your thoughts?
Yeah, I'll pull on some of the phrases which Alex just put out there. I'd say the biggest learnings for me were, once, it's obvious in retrospect, but start with the people that you know and know you well and back the horse, so to speak. That's where I found the most traction, people who'd worked closely with me and were willing to back me no matter what. And the other big learning was, as Alex just detailed a little bit, LPs are not homogenous. We refer to them as this homogenous entity, like an LP, someone that invests in venture funds. There's actually a bunch of different flavors, and even within family offices, so to speak, there's a whole adage, you meet one family office, you've met one family office. The reality is people are motivated by different things, and they're looking for something different in the venture funds they're investing in. So figuring out quickly who's actually going to be a fit and triaging them versus who's just looking at you for a long-term relationship is one of the things I'd encourage emerging managers to focus on early.
And your thoughts on what are some of the things one should consider before starting a VC fund? You could also be an angel investor and just stay an angel investor, whether you should go solo or you should have a partner. So what are some of the things you considered before starting a fund?
I mean, I think there's a couple things, and maybe there's some pieces that I didn't anticipate before I went from operating to venture. I mean, I think one is, why should you exist as a fund or as a firm? There's a lot of investors out there. There's a lot of early stage capital. So what's the white space you see in the ecosystem? Why will founders choose you? Is a big reason or a big thing to think about. And the same way as a startup, like what's your reason for being? What is the gap you're filling? What is the opportunity that you're going after that you think is untapped or that other people have missed? And so that would be one thing I think about. I think the other piece of it is different from angel investing. There's a whole piece of it around firm management and portfolio management and LP management. Like there's a lot more operational things that you do in the back side of it that are part of a strategy if you want to build sort of a sustaining firm. So that was something that I didn't fully anticipate. It's actually entrepreneurial. I mean, in building, I mean, you guys know, it's sort of you pound in the. I've never worked harder than I do now since I joined this firm. And part of it's a choice to go join an entrepreneurial firm or build a firm from the ground up versus go joining a big platform. And that was a choice because I like to operate and build. But it requires hustle. I think a lot of people, at least when I was in grad school, there's sort of a perception that VCs just sit there and they pick these great deals and they issue money and everyone's chasing them. It's sort of this glamorous thing and you read about it in hedge fund, like it's hard, it's competitive. And so to get after the best founders and to get into the best deals and things like that, you got to hustle, both to get into them and then afterwards to help them, to make them be successful. So it's not for the faint of heart. It also takes a really long time to make money.
Yeah.
If your ambition's to make money, it takes a very, very long time. And we can break that down and why that is and what that looks like. But just FYI, it's not overnight.
Yeah, my calculus when I was leaving and strategizing about leaving before I left was, I'm a career venture capitalist. I had one job before. I did telecom market research in Boston in the internet 1.0 boom, and then joined Battery and was there 20 years, over 20 years. So, I'm kind of professionally useless. And at a couple points along the way, at my time at Battery, I thought about joining some situations or companies that had come through or I helped incubate, but ended up not. And so I knew I was going to keep doing this. And I also knew, I'm from Providence, my wife's from Boston. Like, I wasn't going to move back to the West Coast and join friends or something. And, I could have stayed for longer at Battery. But there wasn't something in Boston that, there are a few firms looking for, middle-aged venture capitalists. So I kind of knew I wanted to start something. And I was fortunate to have some friends in the industry who, are friends and mentors and had started their own firms in the past. And so one of your questions, one of the great pieces of advice they gave me was, with regards to, should you do this by yourself or with somebody else? And that was, it's basically much easier to divorce your partner than it is to blow up a GP, LP entity. And so it's not something, I think there are many benefits to having partners, but if you're thinking about that, it should be somebody that you know very well for a long time, perhaps have worked with, co-invested with. Like, this is not a profession where you have 3 coffees with somebody and then you decide, hey, let's start a venture capital firm together. Because, when times are tough, when times are good or easy and you make money together, or have a great outcome or work with an amazing founder, everyone's friends and everyone's slapping each other on the back and, aren't we all smart and all this. But, you learn about your founders and your co-investors when things don't go well. And the reality is we're in the early stage business. And so things often don't go well. Even for the companies that end up having great outcomes, the road is rocky. And so having some context for how people behave and deal with situations that are, suboptimal, where there's ambiguous information, yet you still have to make a decision, is really a key part of building trust and a partnership together. So I would say, if you're going to do it with somebody, make sure you know that person really well, and hopefully that you have complementary skill sets, or somebody can be more technical, somebody can be more business. You could both be business or both be technical, but have different sets of networks and relationships, which is beneficial for looking at deals, for deal flow. Even if you're thinking amongst a pool of potential partners, think strategically about, what would be the right combination to hopefully make the best investments.
Yeah, within the evolution of venture, I'd say the trend towards solo GPs is fairly recent, but I actually think it's overwhelmingly a good thing because people can be high conviction. And frankly, I think that the best investments at the earliest stages are made by high conviction, not high consensus. And there are plenty of venture funds that I can think of and point to where partners did have shotgun weddings, so to speak, to have LPs get comfort that there were multiple people around, you didn't have the same degree of key person risk, and invariably those end up falling apart. To Alex's point, how can you make sure that someone's going to make a high integrity choice even under duress? And there's no way to speed run that. You really have to work with someone for a decade plus to have seen them across a bunch of different circumstances and know that there's someone who's going to do the right thing.
Yeah. Lily, to the same point, you are 5 partners in the firm. What is the investment decision making like and the team dynamics between all of you?
Sure. So we're 11 people in the firm total. We are 5 partners, so we're quite sort of top heavy. 4 of us are investing partners, and 1 is an operating partner, which is a little bit different. So his role really jumps in with founders after we invest. So from a decision-making, I actually agree that I think consensus decision-making leads to sort of median outcome. So we have a model where in order to do an investment, you basically need 2 partners to sign up on it. So we have a lead and what we call a concurring. And the job of the concurring throughout a diligence process or getting to know a founder is sort of to challenge and poke holes and things like that, but it's basically sort of your co-pilot on a specific investment. All of us get to know each deal. We all read the memos, we'll join reference calls, and then we do a sort of partner pitch. And then we each fill out a scorecard individually so that we don't bias each other. And then we look at those answers. And our scorecard, the score doesn't determine if we make an investment or not, but it surfaces insights, observations, questions, things we want to follow up on. So you get the benefit of different perspectives. We all have different backgrounds. We all have different strengths. And so we see things quite differently. For example, this summer, we just made an investment. 2 people loved it. 2 people hated it. It's actually rare that 2 of us like really dislike something. But we still made the investment because the 2 people who had conviction, they heard our points of view. We poked holes. We, suggested more reference calls or poke into that thing or make sure we feel great about that. And they respect it. And so they incorporate it into their process. But at the end of the day, wanted to move forward with the investment, and we support them because we trust our partners, and we say, you know what, maybe you see something I don't see. And that's the benefit of diversity of thought and diversity of perspective. And so the other piece, so that's how we make decisions. I also find I'm an external processor, so I find it very helpful to be able to talk to people talk through things with other folks. And then also just from a firm management perspective, we each have swim lanes on things that we work on in the firm building. So, our primary jobs are investing and supporting portfolio companies, but we also do a lot of things here in the community, here in Boston. So we have a big community model. We do a lot of events. We have relationships with LPs. There's just a lot of things that we do. We have marketing. And so we each kind of have swim lanes on operating the firm, which I'm a middle child. I played team sports. I like being a part of a team. That was a big thing for me in choosing a firm. And even actually compared to some big firms, I didn't want to feel like a lone wolf, go do your deals and I'll see you on Monday. I wanted a more collaborative environment. But to your point, we went through a generational transition. We've been through some hard stuff as a partnership, and it's only made us stronger, and it's given me more conviction in my partners. But it can be the type of thing that blows up and is unpleasant if you don't have the right group of people. So it is like a marriage.
Yeah. Talking about investments, all 3 of you are early stage investors. There's barely a product market fit yet. So what exactly are you evaluating in a startup? And how many gut investments have you made in your career? Alex.
Calculating the percentages in his head right there.
All right. I'm terrible. I'm terrible at math. I'm not a finance person. And fortunately, when you invest in the earliest stage companies, there's very little finance to do. Divide your investment size by the post money, figure out what you own. The spreadsheet they're showing you is mostly BS, like financial plan. Don't show me a 5-year projection. I don't care, right? Like, don't waste your time on fun with Excel. So I started investing in May 24. I've made 8 investments, and then I had sort of 2 angel investments that I made in the time between when I left and when I started, that I sort of rolled into the fund. That's a reasonably high pace. Decision making, another thing which we didn't touch on that's extremely different is at Battery, you're the lead investor 99% of the time, 90% of the time. So you either decide to do a deal or not. Maybe you want to do a deal and you lose it, but those are sort of the possible outcomes. Here, I'm investing plus or minus $500,000 in rounds that could be, 2 to 10 million, and I'm not the lead investor. Most often. Sometimes I can help that round come together by introducing deals to Lily or Will or other friends. Sometimes not, like the founder has other relationships, they're running a process. And so you have, I had to recalibrate, when you're the lead investor, you can take up a lot of the founder's time and do 10 meetings or 5 meetings, and you do a bunch of diligence calls that they're not on and some that they're on. But I tend to think of it, I meet a company today, I think it's interesting, I like it. What's the most time efficient, for me and for them, where I can figure out if this is a deal that I want to invest in or not. And so often, I'm on the call or I wrap the call and I think of like, okay, who are the 2 people in my universe I can connect this person to? And, that's sometimes like a deeper technical dive and a deeper business dive, or put them in front of somebody who looks and feels like the shape of the kind of customer that they want to ultimately sell to. And like I do those 2 calls and like with people you trust, and that generates a decent, a good amount of signal for you to kind of figure out where your head is at. And then hopefully those calls are also very beneficial to the founder and show the founder that you get what kind of person they are and what kind of people are their people, and that you know their kind of people or their kind of customers. And that's a way to also rapidly, like, it's a full duplex relationship, right, to sort of build the bidirectional trust. And so that's my kind of shorthand way for, getting 80% of the work done in, 2 calls. And then, of course, you do background stuff that you don't have to burden the founder with, but.
Yeah. Will?
Yeah, I think it's really easy to over-intellectualize this stage of investing. At the end of the day, people like to break down the framework of team product market or team market product, and people have rough percentages they assign to each of those. At the end of the day, you really are investing in people and ideas, and there's a lot to be said for find founders that you think have a deep understanding of the space they're building in and a massively unfair right to win. And if they're building in a directionally correct space that you have conviction around, then you should be able to move forward from there. In terms of work and gut feel, potentially a hot take. I know a lot of people have frameworks that they use to try and quantify certain founder archetypes or profiles. These are different dimensions we want to rate someone on kind of 1 through 5 or whatever it is. I fundamentally think that all of those are just gut feelings that people are then trying to work backwards to provide some intellectual rigor around. But the reality is like, there might be some gut investment decision making, but it's a gut that's been built up over decades and decades of experience and seeing the movie play out across a bunch of different areas and having industry experts to go lean on. And so therefore, I think I think even gut decisions can be well-informed ones at this stage if you have the right experience and networks to go lean on.
Right, right. And talking about taking informed decisions, we now have AI, we have stable coins, and we have different technologies coming up. As an investor, what is your learning curve like before making that informed decision? How do you ensure that you know just enough to make a good investment decision?
I mean, I think that the best part of our job, the thing that gets me most excited about it, right, is I get to learn about new technologies every day from people that are inventing them or very close to inventing them, and that is really exciting and something that, I think is a lot of fun. And the beauty is that, yes, over 20 years I was investing. I started my first job was like looking at telecom infrastructure, and I knew a lot about switches and routers and networking, and I joined battery, and then the bubble burst, and everything I knew a lot about, became largely irrelevant for a few years. And so then you have to learn about new things, and that if you're intellectually curious, keeping up with things, and especially now since the pace of new things is rapidly increasing with many of the technologies you mentioned, is sort of really what's fun about it. And I think the challenge is then, at Battery we're very market oriented, like to Will's like team product market rubric or whatever the rubric was, we were very market focused. So, when we did a postmortem historically on why do the deals that fail, or the ones that don't work out the way we thought they would work out, we don't, and I don't invest in science projects, so it's seldom that the founder is telling you they want to do something that can't be done, right? Usually they're building software, it's just typing, and machines are typing now too, but it was usually that you built something that the market, you were too early, you were too late, you were the number 5 priority for the CISO, not the number 3 priority for the CISO, or the VP of engineering or whoever your customer is. And in those circumstances, you can do okay, but you're not going to have a great outcome. And so ultimately, picking the space you want to be in and being in a good market, which inevitably means there will be competition because there are lots of smart people who will also identify this. But picking the right market can make up for a lot of sins that you might induce on yourself along the way in terms of execution or team building or financing strategy or whatnot. But having that wind at your back is always easier than sailing straight into it.
I think a nuance I'd add to that now in particular is markets are changing so fast, or I'd say technologies are changing so fast, which I think is changing market opportunities quickly. And I think unlocking markets that maybe previously looked small, but can then become big. And so for us, it usually goes back to the team and trying to assess their ability to navigate that. And we use this term internally, we call it heat-seeking missiles. Like, so is this a founder that's going to understand where the opportunity is as it changes because it's going to change? So in that framework of team, market, product, like we assume the market's going to change. We definitely assume the product's going to change. And so what you're really banking on is the team and their ability to navigate those two sets of changes and match the market shift and the opportunity shift with the value prop that they're delivering. So for us, it goes back to team. It is changing really fast. You know, I hope I'm never the smartest person in a room. I never am. But, my hope is that the founders know way more about the market and the technology than I do. And my job is to sort of assess their savviness in it, which is often when we call upon deep experts or domain experts or prospect customers and things like that. So we're sort of triaging these different signals. But it is intellectually so amazing. It's such a privilege to get to learn all the time. Every 30 minutes, you're kind of taking a different pitch and learning about something else. But you need to have enough of a prepared mind to be able to sniff test and ask the right questions and then have a network to help you really assess the savviness of the founder. And by savviness, it can either be it can be a question on their vision, on their view of where the world's going, on their technological approach to how they're solving the problem. There's various ways to test it, but that's what I'm assessing.
Yeah, I think these two have pulled out my two favorite phrases. So intellectual curiosity is one and prepared mind is the other. I think that's the beauty of this job, the variety where every single day you get to be educated by subject matter experts on what they're doing. And you get these brilliant people that are trying to will these things into existence that should not exist. And that's the thing which gets me excited about working here. I will say that in terms of prepared mind, like that's part of the opportunity. It's a massively competitive, fast-moving industry. So if you can bring to bear your expertise and move quickly and build conviction before other people can, you can use that to your advantage. And conversely, sometimes part of the job is recognizing when you don't have that edge, where it's like, hey, like I love the founder, but I really don't understand the space. I'm not going in eyes wide open into what the risks are and knowing when the time is to step away and just be like, hey, look, this might be a great investment for someone, but this isn't a great one for me.
Yeah. So when you are evaluating founders, the founders are also evaluating you. Tell me some of the qualities that a VC should have or the resources a VC should have to be an ideal investor for that founder.
It's surprising to me, actually, and my recommendation to all you, it's shocking how many founders don't reference VCs. We do reference calls for a living. We'll, call, people we know who you worked with or whatever, but very few founders ask for references on us, or at least me in my experience, and I would definitely do that.
Lily?
Yeah, I've seen the best founders I see are very thoughtful about who are they bringing around the table and why, and they might pick sort of a portfolio. I mean, they might pick a couple of different investors that bring different things. So they might pick one of these two gentlemen who have sort of deep domain expertise in very specific areas and very strong networks there. They might bring in somebody who, we have actually sort of a broader community access. So from a bigger, broader network perspective, that may not be unique domain expertise, but access to a broader community of people. I also see them bring in, maybe two different networks. So I see people do sort of East Coast and West Coast because they want access to both. So I see people build syndicates. But I think as an investor, you have to know what is the thing, like why is somebody going to choose you? Because just as much as founders are pitching us, we're pitching ourselves as to why should they take our capital versus somebody else's. And so you should know which lane you fit in terms of why someone's going to choose you. For us, we're very stage specific. We only do pre-seed and seed. And so oftentimes we'll get chosen, I think, to be that stage specific business building sort of, partner alongside of them. Both because we've done that stage a lot, and so we have sort of knowledge and reps on those early things. We get calls like, do I need this type of insurance? And like, what, payroll platform should I, like, so very sort of nitty gritty stuff to strategy to, critical hires. Whereas, a multi-stage firm, they might choose for a different reason. And so I think you have to know which lane you're playing in and why, and then make sure that your value prop resonates in the market with founders around that.
And when you've made your first 5 or 10 investments, the founders can reach out to you, call you, and you can be available. But as the portfolio grows from 10 to 100 investments, how does the portfolio support change over time, and what do you do about it?
It's a great question. I mean, I find that people's needs ebbs and flows. So at any given time, for this fund we're investing out of, we'll make 30 investments as a group, and so I'll probably do 2 or 3 a year myself, and so it's not that many that I can't sort of support it. And then I feel like oftentimes people will graduate. So if they get to it, as they get to a series, I feel like we're most intense in probably the first 2 years-ish of a founder's experience, and then they'll go raise an A. And they'll still call us for certain things, and I think actually, in particular, you become the trusted partner because they're not trying to posture for the next round or whatever it might be, so you're kind of in their corner. So I find we get the calls of like, I'm not really sure about this, should I tell the other investors about it, da-da-da. So, I mean, we try to be on call. It is a services industry. Like, I don't know about your spouses, but mine, are like, oh, that 10 p.m. call thing is real. Or that Saturday morning thing on the side of a soccer field. Like, you do need to be available because that's part of what you're sort of pitching and adding value to. So, I think it's just sort of, it ebbs and flows naturally. We do have a team that helps us. We do bring in advisors and experts that hopefully are really good at a specific thing. So I try to get some leverage that way as well. But that's part of what makes this a hustle job is you got to be on call.
Yeah.
Yes. And Murphy's Law invariably rears its head with that regard to your vacations or whatever. I tell my founders, which is a great phrase that I blatantly ripped off from the Founder Collective team, which is that I want to be your favorite uncle, right? Not your parents. And especially because you're typically not the lead investor, or I'm typically not the lead investor, it's a little bit easier to do that. All my founders have my phone number. I'm on WhatsApp with them all the time. I work half my portfolios in Israel, so my calls are not, I'm not up at 10 p.m., but I am up doing calls at 6 or 7 a.m. And so, but there is an element of, right, it does ebb and flow. There are key things that, they realize that you can be helpful with, as well as, assuming that the company goes on to raise other rounds, the network of people that they have in their orbit, will continue to increase. And hopefully you earn the right through your relationship and the help that you provide to, still be in the inner circle. But that's not a given, but something that needs to be earned for sure.
The additional thing I'd add is a lot of it just doesn't feel like work. Like, you love spending time with your founders. So yes, there are some conversations which are more fun than others, but ultimately when you are going to work with these brilliant people and they're leaning on you for trusted advice at crucible moments for the business, that's kind of what you live for.
Yeah. So last question before we open up for Q&A. This is Startup Boston Week. I want everybody to tell me why Boston and not Silicon Valley? Alex.
Let's see, I think Will and I both, well, did you live in the Bay Area? Mm-hmm. Yes, we've all lived in the Bay Area, and sometimes I joke with founders, right? Well, we either passed or failed the intelligence test and moved home. Mm-hmm. When I started over 20 years ago, right, there was a big debate, Boston, Silicon Valley, why aren't we Silicon Valley? I think my wife in business school also took a class that was sort of like the history, comparative, techno-anthropology of the origins of the technology industries here in the Bay Area. And I think that meta conversation, is pretty boring and not, there's amazing people here. There's amazing companies that have been built here. I am geography agnostic, so I love to back Boston companies. I love to back companies in other places. So while I'm not a Boston homer, there's, many, many examples of great founders and great companies and, great technologies that have, started here. We do need to do a better job of keeping many of those people here. I'm all on that team. But whether it's, you can think of areas, in my sort of universe in security and data, now in AI, like there's certainly no shortage of companies and talent here. And then I have companies, I work with a lot of Israeli companies, and many of them have engineering in Israel, set up go-to-market in Boston, or then satellite engineering sites or customer-facing org here. And so, there can be both can sometimes be the answer. So that's kind of how I think about it.
Any other comments?
Sure. So we are a Boston-based firm, and we're bullish on Boston, but we're not exclusive to it. So over half of our capital is here. Over a third of our capital has gone to companies coming out of the academic ecosystem here. Those folks don't always stay, but part of our strategy is to intercept the great talent that comes through here. There's 250,000 students that come through the city every year. There's more research done in a 4-mile radius right over there than almost anywhere else in the world. And then you also have all these interesting, there are a fair number of billion-dollar, in my world, B2B software. We do a lot of applied AI to different verticals, but Klaviyo, Toast, HubSpot, those companies are starting to spin out the next generation of talent and founders that we've been able to back. So, there's no shortage of sort of talent and tech here. I think the other things that are interesting is, people, I think if you look at the data, like a lot of employees stay longer. They're loyal. And also from a time zone perspective to places like Europe and Israel, there's a lot of advantages to being here. There's also a lot of experienced operators. So it's not just the technical talent, but it's people who have built companies to billions of dollars. And then there's also a lot of customers here in certain segments. So obviously biotech and healthcare is very strong, but financial services and insurance, cybersecurity, robotics, a lot of what we think of as sort of the hardest problems that are getting solved are being solved here. I think there's sort of a knock on Boston that we're kind of very heads down and sort of conservative in a lot of what we do. And so I think part of what the next generation of VCs can do in particular is bring a little bit of the mojo of the West Coast and New York and bring some of that to Boston and then combine it with what Boston does really well, which is not a lot of puffery, but go solve really hard problems and do it well. From a VC perspective, I think, I think a lot of people are chatting about the world is bifurcating into consensus investing and pre-consensus investing. And I think a lot of the talent that we find here, I would say, is kind of pre-consensus. It may not be as obvious. It may not be the first researcher who spun out of OpenAI, but it's somebody brilliant doing something unique. And so if we can catch them early, that's a big part of our investment thesis, is catch them before they become obvious to other people.
Yeah, the whole SF, Boston, SF, everywhere else thing really cracks me up. There's a certain irony to the fact that for a business really focused on capturing outliers, we all force the very same prescriptive playbook on every single founder. But for me, as I think through kind of why Boston, I think there's insanely bright, driven people here who are very no BS and just get on with the hard work. Versus you see a lot of kind of the SF culture. There's a lot of self-aggrandizement or what's in it for me, which can come to dominate the startup scene to some degree. I also think there's a meaningful advantage to understanding what's going on out there, and that doesn't mean moving out there. That can be kind of spending whatever it is, if you're a founder, like a week, a month, and understanding what's going on in the zeitgeist and being connected to the right people, but then having a very loyal, stable team here which you can build with and scale with.
I think, sorry, I'll just add one more thing. I moved back from the Bay Area to Boston in 2008, and part of me was like, oh, what did I just get myself into? And from then until now, the number of not only the three of us, but there's a tremendously much more vibrant early stage ecosystem of investors and angels who are willing to engage with companies at the earliest stages. And so I think back then it was like, oh, I don't have, ARR was barely a thing. I don't have $1 million in revenue or $1 million in ARR, so I can't go talk to the big firms who are here because that's what they want to do because they need to invest a certain amount of money. Well, that's completely different. And so there's plenty of great early stage capital. People take on technology and team building risk. And I think that's something that's been like a tremendous net positive for the whole ecosystem and is dramatically improved in the past, decade or so.
I think the other thing that changed post-COVID is that the later stage investors from the West Coast learned that they could invest outside of their backyard. So I feel like when I arrived in 2018, a lot of people, they felt pressure to go move out west in order to raise their Series A, their Series B, because that's what the West Coast guys were telling them to do. I think COVID kind of changed that. And so actually, if you look at sort of later stage capital coming into Boston, I think almost 70% of it has come from outside of Boston. And whether that's good or bad, I don't know, but I think it at least opens the door for people who want to stay here, feel like they can. And then the other thing, I don't know if you guys are hearing this, but I feel like there's so much flurry in SF that the SF investors are looking to get access to deals that other people haven't noticed yet. So I'm getting more calls around, hey, what are you seeing on the ground in Boston, as they're looking for things before they're obvious and hypey and expensive in their own ecosystem.
Well, go Boston. With this, we'll open up for Q&A. Do we have any questions?
Hi, how are you? I'm not building a VC. I'm a founder working on a SaaS solution to improve board meetings for nonprofits. But my question is around, I can always use resources to do more. People invest in the product, what have you. But I don't really know what or why. And so I guess I'm curious, when you're talking to founders, do they need to come to you and say, yes, I need money now and I know why I want to use it, or is that more of a conversation?
Well, you should also build a product to improve board meetings for for-profits,
Yeah,
because we've all sit in a lot of terrible board meetings over the years. The how much should I raise question is one you often have with founders. And these days, most of the use of funds is really people, and it's kind of always been, right? You might have some cloud costs, you might have, a little bit of overhead or admin or stuff, but, 80% of your spend is people. And so I always try and have them think about it, and I like to think about it like on a one slide or one piece of paper. It's like, what are the customer things I'm going to accomplish? What are the product things I'm going to accomplish? And how much cash am I going to burn in that time, and lay it out quarterly. And that lets you see kind of how these things align. And that also lets you think about not like I should raise, the dollar amount you're raising is not the input, it's the output of how much time and what am I going to get accomplished with the customers, with the product in that amount of time, building in buffer and, if appropriate for your business, like enough time to go raise the next round. And I think that just kind of crystallizes the key items in a way that, you don't have to be reasoning about the Gantt chart for your software development team or the, sales funnel at a very granular level, but you can kind of see how all these things interrelate and lays it out concisely. And I think it's a way I like to think about it, and I think, has been good for founders too.
Yeah. Next question.
Thank you. This is a question for Lily. In your article, Don't Hire for Cultural Fit, you argue for assessing attitude, aptitude, and ability to build a more diverse startup team. When it comes to your own operational team, what unique attitudes or aptitudes do you believe are essential for the people who manage the mechanics of a VC firm?
Wow, well-researched question. I'm impressed. I actually think it probably comes down to the same thing: attitude, aptitude, and ability, in that order. I think attitude is probably the most important thing and the thing you can't teach. And for us, what's really important, just, everybody build their own culture, but for us at Underscore, I think this idea of a can-do, go get it, hustle, do whatever it takes. We're a relatively small firm, we're pretty scrappy, so some people, we're all unloading the dishwasher in the kitchen, and we're all, putting big things together. So I want somebody who's willing to do that. Aptitude, I think, is hugely important, particularly in this market, and it's probably risen to the top of my list for attributes I look for in founders, as well as our own team. And what I mean by aptitude is around pace of learning and how quickly are you applying those learnings into your execution, because things are changing so fast. So I'd put that as the second. And then ability is useful, but I think if you hire for attitude and aptitude, they can learn. And so most of our team, we all have different backgrounds. I mean, out of our partnership, we had somebody who was a serial entrepreneur. We have somebody who's been a career CFO. We had somebody who's been a founder, but also a quant who worked on Wall Street, and he was an Olympic skier. We have somebody who, everybody has a blend of operating background and maybe a little bit of investing experience, but most of us don't. And then so you need to be able to learn that along the way. So I think those are the things that still matter most. We also, I think life is too short to work with jerks, and so kindness is very, very big in my book. And this is a people first business, and treating people like people and thinking about the whole human. That's essential to who we are as a team.
Yep. Next.
Hi, thank you so much. I wanted to ask, when it comes to the decision to either be a lead investor versus to co-invest with a different lead investor, what's the difference in is there a tangible difference in the way you make that decision, and what gives you the confidence to be a lead investor when you are?
There we go.
Part of it's a function of fund size. So some of us have funds that aren't big enough to properly lead legitimate kind of seed rounds. So that necessarily puts you into more of a follower camp. I think the more that absent, I think the point you're raising is if you can lead the whole round by yourself, what's the circumstances in which you're willing to give up kind of ownership in the company? I know many people at big seed funds who say, hey, look, if I have conviction around something, I want to lead it. I don't want to co-lead it. And this is getting a little bit into the nitty gritty of VC fund sausage making. But I think there are certain fund sizes at which it makes sense versus there are some dead zones you can get trapped in where you get caught in between where you're too big to follow, but you're too small to lead a proper seed round. So I think it's important as you think through kind of fund size that you back into something which makes sense for your portfolio construction.
I think the only other thing I'd add is we're a group that usually leads or co-leads, just given our fund size. And I think oftentimes we'll co-lead, particularly if we think that there's another firm that can be a great strategic partner and add something different. So for example, we just did a robotics deal. We're not experts in robotics, but it's a B2B software go-to-market. So that's what we bring, and then we co-led with somebody who's deep on the robotics side. And so it was a nice pairing of expertise or value that you can bring to the founder and to the company. But I will say, understanding fund math is something that I don't think a lot of people, before you jump in, really spend a lot of time thinking about. It's really important. There's a lot written about it, so go read about it.
Yeah. We have time for one last question.
Do not.
Okay. That's all we had for you. Thank you so much for coming to Startup Boston Week.
Thank you, Rubika. Really appreciate it. Huge thank you to our speakers. Let's give them a very big round of applause. We do have a lot more in store for today and tonight. We will have our closing party and startup showcase happening right here at Suffolk University. We know that you want to mingle after the event. I 1000% encourage it. The only thing that I ask is you do not do it in this room. Now, if you saw my run of show, you probably wouldn't want to leave either. Unfortunately, you must. I need to reset this room. And even if your next session is here, I just ask that you step out, re-register with the folks at the desk. Virtual attendees, you don't have to go anywhere. Just choose the next session in your schedule, and we'll be back with you shortly. Now, I know that you guys have probably seen a lot of fabulous photographers running around. Kevin Ty from 3 Circle Studio is our official photographer. So grab him for a photo, and you'll get a personalized Startup Boston Week photo album to look back on all year. They look super great, nicely branded for your socials. Update your LinkedIn, people. If you have not yet, I have that QR code right here. So come and see me after the session, and we'll see you at the next one. Hope to see you all at the closing party. Thank you.
Thanks. Oh, wow.
Sure.
Sure.